Good morning, everyone. My name is Sriram from the Commodity Research Desk at Reliance Securities. Welcome to the weekly commodity market update. Beginning with the bullion side of things, internationally and domestically, we saw the gold prices extending gains in this week, probably supported by a fall in the US Treasury yields. Of course, the dollar rally also stalled this week and also lent some support. On the data front, data remained mixed. The non-farm payroll last week was robust, but the modernization in the US wage growth could allow the US Federal Reserve to skip a rate hike in the month of June, and this limited downside for bullion. Also, new orders for manufacturing goods and the ISM services PMI numbers both came in lower than expected, and this too kept the dollar rally stalled and lent some support to the bullion. So, looking ahead in the coming week, both gold and silver could remain range bound as investors will await more cues to assess the Fed interest rate path ahead of its monetary policy meeting next week. The recent data has suggested that some concerns remain amongst investors about the resilience about the US economy, and this raised hopes that the Fed may not hike in June, and that can lend some support. According to a CME Fed Watch tool, markets are factoring in a 81% chance of a status quo from the Fed in this month of June. But ahead of that meeting, we have the US inflation readings as well that could also have a key trigger. We feel that there could be a chance, a small probability, that the US Fed may hike rates in the month of June by 25 basis point as inflation in the country in the US remains elevated, and it could take some time for it to reach the Fed's 2% target. So we feel that the Fed may argue that the inflation remains elevated, and that's why we are hiking by another 25 basis points. So we cannot rule that out completely, but there's a fair chance they might hold rates going forward in June, and probably say that we need to look at the impact of all the rate hikes on the economy over the past 1 year or so. So markets are still undecided on what can be expected from the Fed, and due to that uncertainty, we feel bullion markets can remain extremely range bound. After the Fed, markets could be data dependent, data driven going forward, and we feel that the ECB rate and the Bank of England meeting outcome is also due in the same week, and that could also have a small trigger on the bullion market. So overall, we feel markets can remain range bound. Bias still remains on the slightly weaker side of things for bullion markets, and we feel markets can remain range bound to slightly weaker. On the charts, we feel the range for the domestic gold futures is anywhere between 59,600 to 60,600, and the range for the international markets is anywhere between 1950 to 2000 levels. However, these ranges will change depending on the Fed meeting outcome and in the inflation numbers next week. On the crude side, prices continue to struggle in this week as well. Earlier, prices had risen after OPEC and its allies cut output further, especially Saudi Arabia's big output cut. Saudi Arabia, in its meeting on Sunday, said that it would cut output by 1 million barrels to a total of 9 million barrels, a level seen after a very long time from the largest producer in OPEC, and that lends some support. Additionally, EIA this week projected a slight improvement in US petroleum demand in its latest short-term outlook report, and this also lent some support. But after the initial upward movement, prices reversed all its gains amid weak demand concerns. Recent data in the US and in China especially has suggested that demand continues to remain on the sluggish side of things, and that has definitely outshined the supply going forward, and that pulled the markets lower this week. Looking ahead, we see the key trigger will be the Fed meeting. Of course, the outcome could determine the short-term trend for the markets. But after the Fed meeting, data in the coming week from US and China will be a key driver of the markets, which could give an idea of demand in the top consuming countries going forward, at least in the next couple of weeks in the month of June. So markets initially can remain range bound to slightly on the weaker side ahead of that Fed meeting. After the Fed meeting, it will depend on what data comes out. So till that time, we feel the NYMEX July contract can remain between $69 to $74, and the domestic crude will remain between 5,800 to 6,100 going forward. Finally, on the copper side of things, copper rebounded this week on short covering and hopes that the Chinese policymakers will likely further cut reserve ratio and interest rates in the second half of this year to support the economy. Earlier in the week, markets rebounded on the back of some short covering and hopes that the Fed may not hike in the month of June. But data continues to remain sluggish from China, reflecting weak demand. Earlier this morning, exports from China shrank 7.5% year on year. Imports too fell 4.5% year on year. Surplus declined slightly to $66 billion in the month of May. But overall, weak demand continues or persists there, and that will continue to drive prices further. And like the precious metals, looking ahead, we see precious metals, base metal traders will look ahead to the Fed meeting outcome, and markets can remain range bound. Slightly positive bias can be expected ahead of that on further short covering. But if the Fed remain hawkish, we see further correction going forward for the base metals. So markets till the Fed meeting can trade on a slightly positive bias, but a hawkish Fed will pull prices down significantly. On the charts, a range for the MCX June copper contract is anywhere between 706 on the lower side to 730 levels on the upside of things. So that's it from our side. Thank you very much for listening. Have a pleasant day and a week ahead. Thank you.